Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid.
Crypto is becoming part of traditional cyber warfare. Another nation state essentially hacking another nation. That's just going to continue.
Hong Kong also confirmed that its new mandatory licensing for stablecoin issuers will take effect on August 1st. Wall Street's appetite for regulated crypto products seems to be insatiable.
The Genius Act passing the Senate is huge for Web3 professionals, fintech geeks of monetary policy, and the question of what is money.
Circle's IPO, priced at about $31 per share and closed up 168% at over $83, which gives it a valuation of about $8.1 billion.
Stablecoin is now having an opportunity to regulated legal framework in the United States, the potential to do a lot for the broader adoption of Web3 and decentralized business models. The SEC rescinding SAB 121, the accounting rule, and replacing it with SAB 122 sort of cracked the door open for potential IPO.
Nexus passed the Bitcoin reserve bill, but then you've got Connecticut that voted to prohibit the state and local governments from accepting crypto payment. Ethereum developers are proposing a way to cut block times in half from 12 to 6 seconds. Now, institutional infrastructure and regulatory clarity becoming so closely connected to each other. You're building a fintech product. You want to offer digital assets, but wallets? That's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Defense. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Defense. MoonPay scales wallets securely with Defense. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Defense to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Defense wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Defense, secure wallets built right. Welcome to Web3 with FTC. If you're asking how blockchain, crypto, AI, or even quantum computing fits into your business strategy, this is built for you. We talk with the builders and decision makers who are doing the work. You'll hear smart conversations, straight insights, and no fillers. Whether you're a founder, an exec, or just trying to stay ahead, this is where real talk meets real tech. Powered by Fintech Confidential, we keep it practical. We cover the shifts that matter, get the signal, not the noise. So let's go ahead and get started. Welcome back to Web3 with FTC. I'm your host, Ted Huff, and the founder of the fintech advisory firm Voalyre. And joining me is my co-host and confidential informant, Robert Musiala, who's the co-leader of the Web3 and digital assets team at Baker Hostetler, a leading U.S. law firm, and the lead author of the weekly Blockchain Monitor blog. So if you haven't had a chance to go check it out, head right over there to the blockchainmonitor.com and sign up right away, because he covers legal developments and crypto and a whole bunch of other stuff. And I can't wait to dive into it with you today, Rob.
Thanks, Ted. Thanks for having me on the show.
So June 2025 was a month that really showed us a bunch of institutional validation, some regulatory maturation within Web3. And with that, we saw Circle go public with a 168% surge on its public offering debut and raising over $1.1 billion. And then not only that, but the U.S. Senate passed the Genius Act with a strong 68-30 bipartisan vote, creating the first federal framework for stablecoins. And internationally, regulators, they were not taking a rest either. In the EU, Singapore, Hong Kong, they took decisive steps to implement very clear rules on digital assets. But this progress is happening against a challenging backdrop. The digital asset industry's lost over $2.1 billion due to security incidents just the first half of 2025. Here's what we're going to cover today. First, we're going to talk about institutional adoption, where Wall Street's appetite for regulated crypto products seems to be insatiable. The market dynamics, where internal pressures and external warnings create this really complex picture. And then we'll dive into the regulation, starting with the U.S. federal crypto policy, where this legislative momentum is meeting new philosophy from regulators. And then we'll dive into the state developments, which are creating this really interesting patchwork quilt across the U.S. And then fifth, we'll dive into the international regulatory convergence as multiple global hubs have unified on the purpose of driving digital assets forward. And then we'll close it out with some technical developments, let you know how the technology is moving forward, not just what's happening around the technology. June has shown us that this industry is moving way past speculation and is really driving into infrastructure. And it's a shift that we're guiding our clients through at Voalyre. What's shining brightest for you around Web3 in June?
Well, from a legal perspective, which is how I tend to look at things, the Genius Act passing the Senate is huge for Web3 professionals, Fintech geeks, and geeks of monetary policy and the question of what is money. This is a major development and really historic. It's not law yet, but having passed the Senate, I think we're all confident that it will become law and we will have a regulated stablecoin market and clear framework for stablecoin issuers here in the US. And that is going to do a lot for the advancement of Web3, which, as you said before, really relies on stablecoins as an infrastructure and payments layer. Mm-hmm. And with stablecoins now having an opportunity to enter a regulated legal framework in the United States, that really has the potential to do a lot for the broader adoption of Web3 and decentralized business models. And this is absolutely the next big step in the evolution of payments.
At my advisory firm, the single biggest story that we've been tracking for our institutional partners this month, Circle's IPO, priced at about $31 per share and closed up 168% at over $83 on day one, which gives it a valuation of about $8.1 billion. And really, the thing that was driving that forward is that the investor demand reportedly was about 25 times, not 25%, 25 times oversubscribed, which really is signaling like the market is ready. It's hungry for these regulated digital asset companies. And that confidence seems to continue to be echoed in the ETF market as well, because US spot, Bitcoin, and Ethereum ETFs, I mean, they've attracted nearly over $6 billion in new capital in June alone. And with Bitcoin funds seeing 15 days of straight inflows, no breaks, no changes, just coming in. And really, as I look at some of the things that are going on, this is fueling a lot of the predictions around this being not the hot girl summer, but the altcoins summer, really, for these things going on. And Bloomberg analysts have been raising approval odds for products tracking Solana, Litecoin, XRP to 95% by 2025. Between Circle's blockbuster IPO, the flood of capital into ETFs, it really seems like Wall Street's appetite is insatiable. And this is just the beginning of public market validation for digital assets. What does it mean when analysts are already predicting this altcoin ETF summer? What is it that you're taking away from all of this?
The company could not have picked better timing in terms of the Genius Act passing the Senate around the same time. That clearly gave...
That timing was impeccable.
Impeccable, really. It is unbelievable, really, because it really gave the institution...
I'm just glad you didn't use the word unprecedented, because I think we've heard enough of that.
Well, I guess it was precedented because they're not the first digital asset company to go public, but they are one of the first. But being the first stablecoin issuer to go public is a pretty big deal. And again, the timing around the Genius Act passing the Senate absolutely helped in terms of institutional acceptance. But one of the things that I want to note that I think was operating behind the scenes here is a piece of the kind of groundwork for all this that was laid down very early in the year, shortly after the new administration took over, and that was the SEC rescinding SAB 121, the accounting rule, and replacing it with SAB 122. The big change there was the prior rule had required entities custodying their customers' crypto assets to record those holdings as liabilities on their balance sheets, and that was a requirement. And so that requirement, from an accounting perspective, made it really difficult to show a healthy balance sheet for a company that is custodying crypto on behalf of others. And the change in the rule essentially allows crypto custodians to apply accounting standards on contingent losses and liabilities and to make a determination based on those standards as to whether they should recognize a liability related to risk of loss associated with those crypto assets or not. And then if so, how to measure that loss. That rule did not really apply to Circle. They don't custody crypto on behalf of others. It does apply to many, many, many other companies in the crypto space that in various contexts custody crypto for third parties. And the change in that rule, I think, sort of cracked the door open for potential IPOs in the digital asset space.
Mm-hmm.
That was one hurdle out of many. I think Circle dealt with some of these other major hurdles and was able to clear those hurdles. And by successfully going through their IPO, we've quietly seen two other crypto exchanges go public this year, and that's eToro and Coincheck have both become publicly traded companies in the US. And I think those developments largely were overlooked, but I think are a little bit of a signal that we may have room for more IPOs of digital asset exchanges and other business models that involve custodying crypto assets for others.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. You look at those pieces, but the other side of the house is that we've got all these ETFs coming. Like I mentioned, over 70 different applications for ETFs that range from Bitcoin all the way to one of the silliest meme coins. Help me understand from a legal perspective what that does when we're looking at the market itself.
To me, what's most interesting about the ETFs is something we mentioned on the last podcast, but I want to highlight it again. And that is the SEC's recent staking guidance, which gave the market comfort that those operating validator nodes on proof of stake networks staking crypto can do so without running afoul of the securities laws. That, in combination with the Pectra upgrade of the Ethereum network, which raised the validator staking limit from 32 ETH to 2,048 ETH, so a massive increase there. Those two developments, which very much unrelated to each other on first glance, but I think they converge when we talk about ETFs, because between those two developments, it becomes a lot more appealing for an ETF that is holding Ethereum-based coins. Can you operate that ETF and invest in the Ethereum-based digital assets? You can stake those assets and redouble your revenue stream, and you can stake those at a multitude greater rate than before Pectra. So now running one validator node, previously you could only stake up to 32 ETH. Now you can stake 2,048 ETH on one node.
We both know the internal dynamics of the market really become complex. And this is where we at Voalyre really earn our keep as advisors, and I know you guys over at Baker do as well, is really helping these leaders see past these bold headlines. One of the things that comes up is the Bank for International Settlements, or BIS. I mean, they issued a pretty stark warning, arguing that, although we're having fun talking about Circle, that stablecoins failed the key test required to be considered sound money. And they feel and they believe that it poses risks to overarching monetary sovereignty, which I find really interesting because I look at it almost the complete opposite of it. But they're also urging nations, if they accelerate their own tokenization efforts, it's a safer alternative. And this, as you can imagine, is creating that clear tension between the private sector work and the perspective of global central bankers. We're seeing whales holding over $14.3 million in ETH. And this happened as global adoption of digital assets and crypto, to be more specific, has reported an increase of 60% in 2025 basis 2024. Now, that sounds like a huge amount, but you have to think about it is that this is happening mostly being led by users in developing nations where their monetary systems may not be as robust or as mature. All this makes me think of is, in one hand, we've got the BIS warning against every warning that the foundation of DeFi ecosystem is on shaky ground. And on the other side, we see the cyclical pressures like token unlocks being absorbed by the market. I would love to understand how you're interpreting these mixed signals about the overall health of the ecosystem.
It's important to remember that there are a lot of different types of stablecoins. Now, at this point in time here in the US, the focus really is on the type of fiat-backed stablecoin products that will be regulated hopefully soon under the Genius Act that recently passed the Senate. That's by and large the safest type of stablecoin from a consumer perspective, from an economic policy perspective. And I would not be surprised if we see the Genius Act have additional consumer protections added to it.
South Korea has said, well, the way most stable coins, or the primary stable coins being used today in the private market, are very heavy dollar based. It's pegged to the dollar, which is very, very true. And their perspective was, hey, this may be a covert way of dollarizationing the global economy even more than what it is already today. So what they want to do is that they want to establish a stable coin that is pegged to the Korean won. to try and reduce the covert dollarization. What I thought was also interesting with that is that they didn't call it a CBDC. They did call it a stablecoin, and it isn't government issued. So it's really nice to see that we're having this in public and private sector usages of a currency pegged stablecoin.
Because a couple of years ago, CBDCs were very much a part of this debate. And now, at least in the US, they're not. And we've really kind of turned the corner, at least from the US perspective.
Well, in the US, some states have banned CBDCs, like not allowed in the US, which pulls into that patchwork that we'll dive into a little bit later. The Senate passed the Genius Act with a comprehensive stablecoin bill. But then over at the House, we had the Clarity Act, which again advanced with bipartisan support. The Financial Services Committee approved it 32-19. Normally it's like within an even smaller margin. Check me on that one, man.
I will provide you more of a sober legal practitioner point of view on the Clarity Act. I think it's an absolutely important piece of legislation, and I am very happy to see it moving forward. I do not personally expect for it to become law this year. I think Congress will be able to come to an agreement on some of the details. I think that the Genius Act was a huge success, but again, it has not passed the House. So it will be interesting to see how the House deals with it, how they either propose to amend it or not. And I think it was smart for Congress to focus on stablecoin legislation first because it is the easier issue. So for that reason, while I'm happy that these issues are getting the attention they deserve, I am advising my clients not to wait and to come up with strategies for a world in which we are waiting for this legislation to pass, not coming up with a strategy where you're waiting for it to pass first.
And one of the things that we've been watching also is this, I don't know, maybe we could call it a philosophical shift from federal regulators. On June 9th, they concluded their crypto roundtable series, which, yes, I mentioned it last month and the month before. They are painful to watch, but they're fantastic to summarize transcripts and really understand what's going on there. Commissioner Hester Pierce has been championing developer rights and arguing that the user of a protocol should face consequences. One of the things it does for me is it signals that the banking partners can get a little bit more comfortable with the industry and how it's aligning with all these different pieces of digital assets moving in the traditional banking. And I feel like we're headed in the right direction, but is it the right direction in the right places?
I would say that I agree with you directionally. We are in a good spot right now from a U.S. regulatory perspective, given that we don't have comprehensive legislation. That being said, I think that we are clearly seeing more alignment in the approaches of the various federal agencies and generally seeing a more market and business friendly approach from the regulators, while at the same time, just as aggressive and potentially even more aggressive approach when dealing with illicit activity and illicit actors. And you mentioned the final crypto roundtables occurring in June, which is great. Sort of the next chapter in all this. But one thing that Chairman Atkins said in his speech delivered at the final, sort of praising the SEC staff that's been working on that guidance, but noting that these are only temporary measures and noting that it's important that the SEC adopt regulations based on their congressional authority to put into place some of these concepts in a more formal way from a legal perspective. I echo your thoughts on Commissioner Peirce identifying the developers of protocols as not people that should be deemed to be in violation of the securities laws and other regulation, but rather focus on the users and what people are using those protocols for. That I think gives some really good guidance and sense of relief to developers of DeFi applications and other crypto-based protocols where they feel like they can safely deploy new products without fear of an enforcement action based not on what they're doing, but what someone else is doing with their product.
We continue to hear financial institutions, we hear regulators, everybody come in and really push for the AML pieces of it. And I think this is also an interesting place because we're saying, hey, don't punish the protocol but punish the people who are using it the way they're using it. And then we have these scenarios where I don't know whether they knew or didn't know a person that was receiving the funds, but you as an individual can only go so far. I guess you could say, given a hall pass, if you've done everything within reason to identify whether or not you're funding somebody. But this is me geeking out as a non-legal professional on this space. Help me clarify from a legal perspective. Am I off the wall on the thought process here?
Well, from a legal perspective, I will say that from the perspective of U.S. sanctions programs are a strict liability regime. So there is no excuse. No one is allowed to transact with sanctioned persons or sanctioned jurisdictions. This was a Department of Justice enforcement action where DOJ announced that they'd filed a forfeiture complaint to take custody of about $7.7 million in funds tied to a scenario where a U.S. company ended up employing overseas IT personnel. And this happens all the time. The employees had used fake credentials, provide the U.S. company with information indicating that they lived in one jurisdiction when in fact they were in North Korea, which is a sanctioned jurisdiction. And so the U.S. company paid these employees, and the employees asked to be paid in stablecoin, which that's the interesting twist, right? This is a scenario that I think U.S. companies are going to encounter more and more going forward, especially as stablecoins become more mainstream, which they will continue to do, where a foreign-based employee is going to ask to be paid in stablecoin. And there are a whole bunch of very legitimate reasons for requests like that, including just simple things like receiving the money faster and receiving it into a place where maybe your foreign government that you don't trust can't get at it, and be receiving it into a place where you as the foreign worker are able to transact with more efficiency and less red tape than you would be with your fiat currency. And these are all some of the great aspects that stablecoins offer. So I think U.S. companies more and more will see requests from foreign-based employees to be paid in stablecoin. Great example of some of the things that U.S. companies are going to have to watch out for, because in the old world, pre-crypto, you're paying foreign employees through a bank account and the bank is going to catch stuff like this. And you have that extra layer of protection. Complain about banks all you want, but in this scenario, that's a very strong extra layer of protection. And banks have very sophisticated programs for catching stuff like this.
That's the thing that we're trying to navigate through. And how does it fit into the policies and the procedures of all of these, both federal and state policies, right? And the state policies they've always been this way. It doesn't matter what you're looking at, it always creates a patchwork. And every company that I work with, they're domestic here to the US or they're globally trying to come to the US, whatever it is, this seems to be a place where we spend most of our time trying to figure out how do we make this happen for them. We're seeing these super diverse approaches from the states. Like Texas passed the Bitcoin reserve bill. Then there's a second one. New Hampshire was the first one. I thought Arizona was going to be the second. I'll leave that one for another day. But then you've got Connecticut that voted to prohibit the state and local governments from accepting crypto payments. Got to go out to California, go all the way out to the left coast there. They passed the AB 1180 with a 60-0 vote. So it was unanimous that authorized the state agencies to accept crypto payments. Now, mind you, it is a pilot program, but also in June, AB 1052 put dormant crypto assets that are on exchanges into the crosshairs of the state's unclaimed property laws if after 3 years of inactivity. Now, mind you, there's going to be a lot more. I haven't dug into it, Rob. I don't think you've dug into it a whole lot either, but my first pass of it is like, it looks like they're normal achievement laws. Like if I were to have bought a car and the dealership tried to send me the refund for my tag and title, or maybe they overpaid on my loan and they tried to send that money to me, it looks and feels like it's following kind of the same direction. But what challenges do you see this creating? And does this increase pressure for even more comprehensive federal law to kind of cover overarchingly across all of this?
The first is this, as you mentioned, this is not new. We've been dealing with these patchwork state regulations in the financial services space for a long time. And there has slowly been momentum where various states are sort of joining forces and collaborating around licensing regimes for money transmitters. And I think that initiative actually is probably the most important one here, because I do think that from a state level, digital asset exchanges and other companies that are involved in accepting and transmitting digital assets from one person to another person or location are going to, by and large, be regulated under the same rules as traditional money transmitters, except with some additional regulations specific to digital assets. I find it fascinating to watch different states debate the strategic Bitcoin reserve issue. And I think it'll be even more interesting to see the states that do establish reserves, where are they custodying those reserves? Because we are starting to see two different state approaches. One in which states want exposure to crypto assets, and they're doing that through the public markets, particularly through ETFs, like we talked about at the beginning. And that's good enough for many states. Other states want to take it a step further. They don't just want exposure to the asset class. They want to actually hold the actual asset as a kind of stockpile. And I think that's where we're going to see divergent views, and different states will take one path or the other. And some states might do both, might have the reserve and also invest in the public markets like Bitcoin ETF products. Question becomes, if we can't give the assets back to the real owner, who gets to keep those assets, the company or the state? And states would argue under the general unclaimed property laws of the states that that money should go back to the state. And in some cases, there are procedures where the state will try to get in touch with those individuals before ultimately taking the funds into the state treasury if that person is completely MIA. And so in that sense, when you kind of game it out in that way and understand that those are the scenarios that these laws are intended for, it's not too scary. But anything where you see a headline or a law indicating that the state's going to take someone's crypto, that is going to set off alarm bells, obviously, for a big part of the industry.
Hey, Ted Huff here. Ever thought about how you could streamline your application and underwriting process? Well, let me introduce you to Under. Why keep using the outdated methods of PDFs when you can digitize them effortlessly? All you gotta do is upload the PDF, send it out for digital signature, and voila, you're set for the digital age. Are you curious on how to make that happen? Head over to under.io/FTC and get started for free. It's really that simple.
Digital assets were meant to be the one place where the governments couldn't seize assets, right? It was like, that was one of the big talks. I mean, even going back to some of the conversations I had at Bitcoin 2025, but like even the conversations there, it was like, I want to hold, I want to own, I want to do this. So one of the things that, as you were talking, it made me think about is like, it goes back to the thought process and the discussions that I've had over the years. Is like, if you don't own the keys, you don't own the crypto. So if you don't want that to happen and you don't want to have unclaimed property as digital assets, put the digital assets in cold storage. Take it out of an area that could have that happen. Like you mentioned, they could go out of business. They could go out of, use the protocol the way it's been meant to do. Take that ownership, bring it in, self-custody it, like take the ownership of that, and you have less to worry about in that space.
It's a saying that will never get old. Now your keys, now your crypto. I mean, it's as simple as that. And so you want to stay out of the unclaimed property rules, self-custody. And that's, to your point, a large driver of where the Bitcoin network came from it originally.
We here in the US are arguing, and maybe not arguing. We've created a complex process for good or for bad, indifferent, however you want to look at it. We've created this process and we've got to live with it, right? Now, in the EU, the markets in crypto assets or MiCA framework, I mean, that keeps getting more concrete and detailed technical standards. But then you've got Singapore. I mean, they enforced a hard deadline of June 30th, which closed a major regulatory loophole. So all crypto firms based in Singapore must be licensed, even if they only serve overseas customers. And there was a huge loophole in that. And that just really comes into the money laundering and the KYC stuff that we talked about earlier. It really does that. Hong Kong also confirmed that its new mandatory licensing for stablecoin issuers will take effect on August 1st. And this here is something that sounds very reflective of the US, is the rules require full one-to-one reserve backing and deliberately exclude algorithmic stablecoins from its framework. Something we talked about earlier in the episode, that there are many types of stablecoins. And I think that's really closely in alignment with what the US is doing. And then the UK, going into that side of the house, I mean, they left the European Union, so they've got their own rules now. So the Financial Conduct Authority, they're proposing to apply the traditional market abuse regulation to the crypto asset space, which is something that we're doing here in the US as well, right? We're applying the existing rules to the crypto asset space where it works, and we're pushing through. And I think that kind of adds to some of the debate or the very detailed or thought-provoking conversations that we're having. They're implementing at a much faster pace than the US while we sit over here and have those conversations. And it seems that we're seeing a global consensus form around these key principles, like the full reserve backing, AML being super important. What does this mean for us here in the US? And does this mean that we need to catch up, or are we still remaining to be competitive in the marketplace?
I am still very bullish on the US right now, and do believe that we will be and are the market leader in digital assets. And I think that is only going to continue. Some of your comments remind me that, and I think a lot of people forget this, but it was actually MiCA, the MiCA legislation in Europe, created a regulated stablecoin framework last summer before the US. Mm-hmm. So they actually did beat us to the punch. Now, I don't think it was very easy for, and still it does not seem very easy for stablecoin issuers to get approved.
Maybe 4 now. There were 2 that were done, and I think another 2 actually got approved in June. So we're talking like 4 institutions in 1 year. And thinking about like, all right, so the SEC has 70 ETF applications? So just look at the contrast, right?
A lot of demand and not enough regulators to keep up with the applications. And I think I don't see that changing anytime soon.
I mentioned at the opening, digital assets lost about $2.1 billion in the first half of 2025. Now, mind you, this is one of those numbers as I talk to CEOs that I advise. I mean, this number keeps them up at night because they're like, well, if I get into it, how much of that is going to be me? And I have to remind them that, hey, this pretty much puts us on pace to match the the 5.8 billion reported investment fraud and losses from 2024. And that's actually a good thing that we're not apply. It's become pretty much stable. Israeli hackers targeted Iran's largest exchange, Novatex, draining it of $90 million. I don't care where you sit on the pro against on this stuff, but that's a lot of money to be pulled out. And it's a real big change in the way that we look at threats and digital assets. This isn't code vulnerabilities. This isn't someone hacking into the system, gaining access that they weren't supposed to via a brute force attack. I mean, this is leveraging human psychology. This is at the core of the risk management strategy that we build for our clients. And Rob, you and I talked about a few things on like really cool, interesting ways of making sure that you don't get caught in that. But we're seeing more and more social engineering it shift over to that. I mean, I get text messages telling me that my Coinbase account has been hacked, but then I go log into Coinbase and there's no notice there. What are the 3 most critical and practical steps that you would suggest individuals and businesses take right now?
This is a real serious issue. And so I'll do my best to give some practical advice in our limited time here. And folks, if you're dealing with these issues, please reach out. I'm happy to talk more offline. But as a reaction to some of what you said, big picture, crypto is becoming part of traditional cyber warfare from a sort of global perspective. We've already seen that with North Korea being one of the largest groups hacking cryptocurrency. And now the example that you gave of another nation state essentially hacking another nation, that's just going to continue. And cyber warfare has been around for a long time. But what's now happening is digital assets are becoming part of that cyber warfare. Someone with a foreign accent can use AI and sound like they're from your home state here in the US. If you fall into that category where you are custody and own a high amount of crypto, first of all, recognize that you are absolutely a target, and that's just the reality right now. And if you're a business custodying a large amount of crypto and you work for that business, you are a target, not to steal your crypto, but to steal the company's crypto. And personal information is out there on the dark web, and it is very easy for these actors to identify things like phone numbers, emails, names, even addresses, you name it. The information is out there for sale on the dark web. And that's usually where this stuff starts. And a lot of times it starts with, as you mentioned, a text message, an email, a phone call. Hang up immediately because you're being scammed. Really, there's really 2 main ways that the attackers gain access to someone else's crypto. And again, it's all by social engineering, but giving away your private key or seed phrase is one of the main ways that attackers are social engineering people to take access to their crypto. And so you should never, ever, ever give away your private key or your seed phrase. That point is worth repeating, as obvious as it may sound. And look, for a lot of folks who are high net worth individuals, ultra high net worth individuals, they're diversifying into crypto. They're not experts in crypto. Take the time to learn some of these fundamental concepts, or even better, find a friend who understands these concepts. The attackers actually don't have access to your crypto. If they did, they would take it without calling you. Well, instead, they're calling you and getting in contact and trying to trick you into sending your crypto to a wallet that they control.
Like I was trying to buy something and they're like, oh, well, we're trying to confirm everything. Can you give me the code that was just sent to you and we can go ahead and confirm this? And I'm like, wait a second. And then so I started thinking about it. So I did research and this is just an account takeover approach. They know they need that in order to do it. And that happens a whole lot of different things. And it's funny, you said, hey, reach out, hire Ted. I actually have a handful of folks, our clients of the firm, that when they get something they're not quite sure of, they have us go research it and go figure it out. Heck, one of the folks got locked out of their wallet and they were trying to figure out, like, how do I get back into the wallet? So we sat down with them side by side and walked through the steps of getting them access back into the software wallet. But that didn't make my client feel any more comfortable, because now they felt like they didn't have access to it. So knowing your 2FA, making sure you have access to that, making sure you have a backup 2FA even sometimes is really helpful. Whether it be an authenticator app that you can download from one of the mobile app stores, use that instead. That's going to give you the best security when it comes to 2FA. Let's go ahead and jump into the technological advancements and developments that we saw in June. And this is the area where I get most excited, because in my experience helping companies scale, this is where the competitive advantages are built. For any healthy fintech application, consistent improvement of network speed and security is essential. And so in June, Ethereum developers are proposing a way to cut block times in half from 12 to 6 seconds. Now, I know that sounds like not a whole lot, and it's kind of even somewhat funny, because layer 2 solutions have already been processing 50 times more transactions per second for well over 4 years. And stablecoin transfer fees in networks like Base are just costing a few cents compared to several dollars that it used to be on the main network. And just 2 years ago, that's when we were looking at multiple dollars on that. One of the things that I thought was really cool is ZKSync unveiled a new prover called Airbender. And that is designed to deliver Ethereum block proofs on a single GPU. And by the way, this task typically takes competitors in the marketplace up to 160 different GPUs to do this. And because of this, it's an open source project. Other companies can borrow from these efficiencies. It's not locked into a single company. And this, in my opinion, is going to really help us accelerate progress across the entire ecosystem, and maybe even get some people to think about different ways of doing things so that we can continue to move stuff forward. Rob, for most folks listening, if they're just a business leader trying to understand this, these technical details sound like gobbledygook. Like, how do you see these behind the scenes improvements, especially in speed and cost, actually translate to the way that they should be looking at the market?
I'll echo one of the points that you made, Ted, which is that in any healthy fintech application, whether we're talking about a digital asset network or something else, continuous improvement is imperative. And if you don't see continuous improvement, you should be skeptical of that network or application. And so seeing these developments, and you pulled out a couple of really good ones from the month of June, but we do see these every month. Sometimes you got to dig for them. They don't get as much press as some of the other news stories.
Those were not easy to find. So yeah, you're right. We got to dig.
They're for the true crypto and fintech geeks like us, but it's healthy to see this stuff, and it's a good sign. And for executives, it's good to know that this stuff is occurring, and to at least understand that it's happening, because when you stop observing it on an ongoing basis, that's a red flag, because any sophisticated payments network needs continuous improvement in order to just remain viable, if not improve. And those improvements really hit on, there are really three main areas, and you hit on them, Ted, and it's speed, efficiency from a cost and data perspective, and network security. And so those are really the three big buckets that I look for when I'm analyzing network upgrades or network proposals. And another thing you mentioned that I want to hit on is, and this is the beauty of blockchain, it's all open source, and that is what has enabled such a robust ecosystem, is that all this hard work that developers put into these upgrades is shared with other developers because they open source the code, and that allows different people to analyze the work of others and their peers and to come up with new ways to improve upon that code, or even use it in ways that the original drafters didn't even think about.
From the vantage point of being a fintech advisor, and there are two trends for me in June that I think are actually going to define the next quarter. The first one is really the institutional infrastructure and regulatory clarity. Now they're so becoming so closely connected to each other. You got the Genius Act, the global rules from the EU, Singapore. Those are coming together, and like we mentioned before, they're starting to look very similar. Circle's successful IPO. I mean, these may feel like separate events, but they're not. They're part of the same trend, creating regulated, trusted channels for institutional capital to enter this market. And the second piece is really the human element. And this is a new area of focus that really the biggest risks are no longer just in code, but in the security process. And we really need to be designing things to fight social engineering. And the biggest opportunities of growth in here are being really unlocked by these layer 2 networks, and really making sure that the technology becomes more inexpensive. And not only more expensive, but it really drives that ability to provide a human error free-ish user experience. We're watching right now the foundation of mainstream financial systems being established in real time. So, Rob, I've laid out my two trends: the merging of regulation and institutional demand, and the new human-focused layer for both risk and opportunity. As you look ahead, where do you see these biggest legal or compliance hurdles emerging from these two trends for the rest of 2025?
So starting with the threat angle, I agree with you that the human component, and especially the threat of social engineering, is the biggest threat to this industry in the short term, the next 6 months in particular. From a product perspective, I think it means that those who are building products will continue to focus on making the technology easier to use from the user experience, but should also consider, how do we create sort of automated controls that can help to catch some of these things like phishing attempts before they end up in losses. And then from like a big picture perspective, we'll certainly see additional guidance come out from various agencies. And then hopefully we see the stablecoin legislation pass, the Genius Act, pass the House and get signed into law. What I do think we will see is a acceleration of the stablecoin wars. And we've already had multiple new stablecoins launched this year, both in the US and abroad. And we're going to see even more both traditional financial institutions enter the stablecoin race, as well as crypto native companies enter the stablecoin race, and may even see partnerships between those two segments enter the stablecoin race. But everyone in financial services is going to be looking to, where do I play in stablecoins, and how do I bring to market the ability to take advantage of this trend, which has all of a sudden started to accelerate not only in the US, but also abroad. So I think we'll see that as a trend.
My advice to founders and executives that I work with is always this: the institutional capital, it follows the regulatory clarity. And user adoption, often it follows the low-cost utility with the best experience. So I tell them, track the progress of stablecoin legislation and the transaction volume. And that is going to be the real guide to where all of this is headed. Well, folks, that's it for this episode of Web3 with FTC. And if this discussion about Web3 got your attention, that's great. There's more where this came from. Go ahead, head over to YouTube, Spotify, Apple Podcasts, or wherever you listen, and hit that follow button. And if you want to stay connected with everything we're doing, everything we're tracking over here, go over to fintechconfidential.com and sign up. That's where all the detailed analysis is available, as well as future episodes you'll be able to learn lots more from. Be sure to share this with someone who's serious about where fintech is going. And if you haven't done it already, go over and sign up for the Blockchain Monitor at theblockchainmonitor.com. I suggest you go ahead and do that too. And as always, keep moving forward.
As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.